Good afternoon and welcome to the Tortilla Mexican Grill PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Richard Morris, CEO. Good afternoon to you, sir.
Good afternoon, everyone. Welcome to our presentation. For those of you that are not familiar with myself and Andy, a little bit of a background on us, or myself to start with. My name is Richard Morris. I've been with Tortilla since 2014, having been in the hospitality sector pretty much my entire career, having worked with brands such as TGI Fridays, Rainforest Cafe, and part of the original management team of Lockfine Seafood Restaurants. So that's me. Pass over to Andy.
Hi, I'm Andy Naylor. I'm the CFO at Tortilla. Been at the business for nearly 6 years now. Obviously, I'm a numbers guy, so numbers is my background. I started my career at Deloitte and worked in oil and gas for a while before deciding I wanted to do something much more fun and work in the eating out industry.
Just a little note around the agenda. I would anticipate this will take 40 to 45 minutes, and I know there's an opportunity for you to submit some questions, which we will try and answer within the time that we have, which I think is 1 hour. So I'll go through the intro and highlights. Andy will then go through the finances. I'll talk about some strategic and operational projects that we have going on this year and from last year, and then obviously the Q&A will come at the end. So for our highlights for the full year of 2022, well, despite all the various challenges around 2022, we did have our record growth year for Tortilla, adding a net of 18 sites to our portfolio, of which 10 were bricks and mortar sites for Tortilla, 5 Chilango conversions, which I'll get onto later, and 3 cloud kitchens, which we added to our estate. Fantastic achievement for the business, especially bearing in mind the challenges that the year was giving us all the way through in terms of costs, but a great effort to all the team to go from our most amount of sites we'd ever owned before was, I think it was 7 sites, so to convert to 18 sites was a fantastic achievement. Other successes of the year, we had a strategic acquisition of Chilango in May 2022. Chilango was a brand that we were always excited about purchasing. We thought it was a good competitor of ours. We were fans of their product and their environments, so we were very pleased to add that to our portfolio halfway through the year. And I can give you an update on that business as we go through the presentation. Something very key for us as well, knowing that we were keen to continue on our growth strategy, we needed to add some strength and experience to both our board team and our exec team. So first of all, from an exec perspective, we added a people director to the business, an area where we've been a little bit short going in the past. So we brought a lady called Holly Foote in from TGI Fridays, also had experience at Merlin. And she's been in the business 5 or 6 months now, and has been a real help in terms of getting us a more considered approach to managing our people, making sure that our retention plans were in place and career pathways in place for our employees and our managers. So she's been a great asset to the business. We very recently brought in a gentleman by the name of Andrew Brooks, has joined us as our head of IT. Now, this is an area we've been a bit short on as well over the years, with Andy sort of doubling up as CFO and head of IT. So with no disrespect to Andy, we felt we needed some support in that area. And Andrew brings with him a raft of experience from Whole Foods, Itsu and Pod. So we're very excited to have him on board. He's only just been with the business 3 weeks now, I think. So he's rushing about familiarising himself with us. And also we've added onto our main board a lady by the name of Francesca Tortilli, who joins us having had experience as the CFO of young brands in Europe. So she specifically joined our business because we were very keen to pursue our plans around Europe, which we have talked about in the past. Francesca brings with a wealth of experience in the franchise world, numerous contacts in and around Europe, and she has so far been helping open doors for us to meet various people in the world. And I'll get on to the franchising opportunities for us as we get further down the deck. As far as the financials are concerned, one other area, we relaunched our multi-platform delivery offer. We were at the time that we last spoke exclusive with Deliveroo. We felt we'd be better served going to multi-platform, and that's proved to have been a wise move for us. And again, as we go through the deck, you'll understand why that's the case. So revenue growth for us was 20% up versus 2021, which was fantastic. Obviously, hugely helped by the amount of openings that we had. But our like-for-like revenue was 16.4% versus the full year of 2019. Hopefully, probably the last time we'll be like-for-likes against 2019, but the market continues to like-for-like against that year. So again, a really good result for us. Obviously, our EBITDA was slightly down on expectations. Clearly, we realised that was all down to the cost implications that we had around protein costs, utility costs, staffing costs. And our net debt figure is at 0.6 million. And obviously, we had quite a lot of cash burn last year in terms of opening the amount of sites that we had. But again, Andy will go into more detail on that through his finance deck. This is a slide we wanted to put together to try and show potential and existing investors how the business looks now in terms of the amount of sites that we have in our total portfolio, which is now up to 82 locations, which is hugely exciting. And that is split out through owned stores of Tortilla and Chilango, our delivery kitchens, our franchise stores in the UK, and our franchise stores in the Middle East. So last year, as stated, 10 UK Tortilla sites opened with 3 delivery kitchens and 6 franchise stores, 5 through Compass and 1 through SSP. We closed 5 Deliveroo kitchens as we came out of exclusivity with them, and 2 planned closures were in Chessington, World of Adventures, and Bankside. Chessington simply because it was only ever a short-term relationship we had with Chessington, and Bankside, the lease ended. We had another site in Southwark not far away, so that we didn't feel there was any necessity in taking on a new lease there. We acquired Chilango, as I've said, in May 2022, and have so far converted 5 of those sites to Tortilla, and we have retained 3 as Chilango, predominantly because they traded very close to existing Tortilla businesses. What's very exciting about this is it shows clearly that Tortilla is now very much a multi-channel business. We have company sites, we have franchise sites, we have delivery kitchens, and we have another brand in Chilango. So opportunities are great and varied for us moving forward. One of the really big areas for us going forward is we now realise that we have a very successful franchise model. We work very well with SSP and Compass. We've opened sites with them last year, and they continue to trade very well. We opened in Gatwick Airport and Bristol Airport. Both of those sites are outperforming the previous incumbents in those locations. So that's proved to be a huge success for us and for SSP. We've also opened 5 university locations with Compass. So we operate on their university campuses, and again, very successfully, taking between £5,000 and £8,000 a week in these universities. And we continue to look at opening more sites with Compass through the universities in this coming year. We're also keen to continue conversations with them around other potential locations in the healthcare sector. And we've also started conversations around the motorway service areas as an opportunity with Lock and Break. So we do see franchising as a really good opportunity of us growing the brand. We have a central production kitchen that allows us to control the quality of the food that goes into our franchise partners' businesses. They have to get the food, they have to buy the food from us, and that's part of the agreement. So with 75% of the product coming from us into their businesses, it de-risks a lot of the food challenges that some businesses have when they franchise out to other companies. I returned last week from our international business in the Middle East, in Dubai and Abu Dhabi. And whilst they had some challenges, as we all did over COVID, closed a couple of their cloud kitchens in one site, it was incredibly encouraging to see the success of the existing business that we have out there now, with all of our sites over there in profit. And Ethos are now very keen to grow the brand across Dubai and Abu Dhabi, where hopefully we'll have a couple of sites open this year from there. Obviously, the opportunities in that part of the world are potentially very, very big. Saudi Arabia is undergoing huge change at the moment, and I envisage Tortilla looking into that market at some stage.
Okay, right, moving on to some numbers then. So on slide 9, you'll see the headlines for the P&L. So we'll just touch on these briefly before going into some more detailed information shortly. But the headline figure, which Richard mentioned, was the 20% revenue increase for 2022 compared to 2021. So that took us to record sales of just under 58 million, driven by the addition of 10 sites, the Chilango acquisition, and also the lack of a Q1 lockdown like we had in 2021. Gross profit margin was down 3.2 percentage points on 2021, and largely driven by the falling away of the VAT support the government provided in 2021. Admin expenses grew in line with revenue, and then the key metric for us as a business is our adjusted EBITDA, which was 4 million in 2022, which is on target with our expectations, which were communicated in October. So we're pleased with that. It was a big drop year on year though, but that was the fall away again of the VAT and the government support packages that resulted in that. So just moving on to slide 10, where there's a detailed revenue bridge, which tells the story really of how the year panned out. So 2021 to 2022, there's only 2 downwards bars on this waterfall. One was the dropping away of the VAT benefit, which is the 3.9 million, and then the other one was the reduction in the cloud kitchen revenues, which is because we exited those Deliveroo Edition sites. Everything else is on the up, which is great. So we had 3.2 million more revenue in from our new store openings, 3.7 million from the absence of a Q1 lockdown like we had in 2021, 3.3 from the addition of Chilango, 1.2 million from the full year impact of the 2021 openings, which obviously opened at different stages of 2021, 0.2 million from franchising, and the remainder was underlying like-for-like growth, which we mentioned before. So coming on to slide 11, which gives you a bit more information around the like-for-likes and the sales channels. Our like-for-like growth last year was very healthy, 16.4%, versus, as Richard said, 2019, which is the most cited comparative period, I think, ever, because of COVID and COVID distortions and VAT and all of that. We use that benchmark because CJ Peach, which is the industry benchmarking tool, was using that last year as well. They reported a 5% like-for-like on 2019, so we sort of more than tripled the number that they recorded. And actually, one thing to highlight about 2022 was that the growth was strong during all of the year, the like-for-like performance. Even in Q4, which was quite badly impacted by train strikes and various other challenges around the kind of chaos that was at the government at the time, our like-for-like growth was still 16% in Q4. So we're really proud of sort of holding our position within the sector during that tough time. And actually, you know, if you look at the another great business within the sector, Wagamama, which recently reported its full year numbers, we were more than double their performance. So that's fantastic to see. In terms of channel mix, just to explain some dynamics of how the industry's changed a bit, delivery was definitely the area which we saw drop away last year. Obviously, as people were feeling the pinch in the wallet, they moved to coming in store. So you'll see from the graph that in 2021, it was about 48% of sales during COVID, dropped down to 37% just before the war started in Q1 last year. And then it started to drop more towards the sort of 30%. We then went multi-platform by adding Uber Eats to our business model. And that's really been able to help us with our delivery sales, which other businesses who aren't just assembling food to order like we are, where you can just take extra delivery volume. I think that's a big strategic advantage that business has for this year and beyond, being able to kind of deal with multiple sales channels on delivery. We expect it to be 31 to 33% for this year, so we expect it to kind of regrow as the year develops. Then on to slide 12. So I guess we're probably one of the things we're most proud of last year was our growth. This is a growth investment story and was a year of record growth. 2021 openings, collectively, there was 3 sites that collectively returned a 56% ROCE based on 2022 EBITDA, which is fantastic and represents the strength of the deals we did there and the strength of those locations. 10 site openings in 2022, and on average so far, those sites are already at around 83% of the sales hurdle they needed to achieve in order to reach their 30% ROCE target. So we're really chuffed with that, because although we had a lot of sites outside of London before last year, it's fair to say that some of the sites we opened last year were in smaller cities and towns, places like Lincoln, Coventry, Leicester, Durham, Canterbury. So smaller places where there are strong student populations, and we're really feeling really positive about our UK white space opportunity, really, as a result of being able to open in some of these locations and performing really well. It will take a bit longer to mature in some of these locations because Mexican food's new, but to already be kind of at an early stage, so close to your investment target, we're really chuffed with that. And I think point to make around CapEx, obviously with all the rising costs, we anticipated this with the capital expenditure, and we worked really hard with landlords to get capital contributions in. And so as a result of that, the average CapEx that we spent on new site openings between 21 and 22 was only 350 grand. So we've kept that number nice and low, which means that the sales targets you're chasing are quite modest, which puts us in a really good position. Last point to note on that really is we've talked about at the IPO that our strategic advantage is that we can take sites that are former retail units because of the whole change of use thing that happened on the high street. More than half our openings last year were former retail units. So we're seeing that there's a lot of white space opportunity with both retail and food units that we can take.
I just wanted to add this slide in because I think it's interesting to see from an investor perspective, and also for us to give us huge amounts of confidence how the brand is now able to trade in very, very, very different locations, very different demographics. If we start with Greenwich here on the right-hand side, Greenwich is a location that we've been looking at for quite some time. And for those of you that know London, you come out of the tube station, it's almost directly opposite you. It's an old subway site that we'd had our eye on for a while. The rent was too high pre-COVID. Anyway, as time has progressed, the site became available at a much more competitive rent, which we were made aware of off-market, because we have a great relationship with a lot of landlords and agents in and around the London area. So we managed to pick this site up. The CapEx was more than we would really wish to spend. However, the site was in a little bit of a state. But we were so convinced, and we knew that this was a great site for us because it ticks a lot of boxes for the sort of people that use Tortilla. Large chunks of the year, there's an awful lot of students around that part of town. As has been shown since it's opened, as you can see in the presentation, that we've been doing over £16,000 a week since we've opened, and we're now very excited because we believe the next 4, 5 or 6 months are going to be crazy busy here with the influx of US tourists and European tourists, as London is clearly one of the places to come to this summer because the pound is so weak versus every other currency in the world. much. So that's a real tick for us. A site we've been looking at, we managed to get it at a lower rent. We've turned it into a beautiful looking restaurant with about 60 sites, with about 60 seats, and we're anticipating some good numbers there coming up over the next few months. But it's already virtually at its maturity sales number that was required from its investment. So conversely to that, we have a site in Derby. Now, Derby is a city that is, from my limited experience of Derby, having gone up there to decide whether we should open a site, there's absolutely no Mexican representation up there whatsoever. All roads lead to the Derby and Shopping Centre, which is where we have opened. The food offering within that shopping centre is fairly basic and fairly unhealthy, which was one of the reasons why we felt like we should go here, because we know that our product is very customizable and can be very healthy. Obviously negotiated quite hard with landlords around a capital contribution, which meant we got a £75,000 capital contribution on this site. So we were able to build this after the contribution just over 300 grand, which is fantastic. It's a great looking site. It's an XYO sushi unit. And absolutely thrilled to bits to say that we've opened almost exactly the same sales as Greenwich. If I'd had a bet on that, I would have lost. So I'm delighted that that has proved to be such a successful business for us. Very early days, of course, but already it's well above its investment case, which was just over 13,500 a week. So I thought it was good to show that this brand now is able to operate in demographics that perhaps 2 or 3 years ago we'd have been slightly nervous about taking. So really, really good success in both of our first 2 openings this year.
So just moving then on to profitability, obviously something in the press that's a favourite topic of the media, but there has been unprecedented levels of cost inflation, no doubt. Here we've bridged the 2021 EBITDA of 8.7 million to the 4 million that we generated last year. And when you look at it from the year-on-year lens, the big things that have impacted us was the VAT benefits dropping away, which we talked about, and also the loss of the business rates and restart grants and those types of government support. The rest obviously then growing factors as we grew the business last year. So then I guess the more interesting thing to compare is the 4 million we generated with the 7 million that was our sort of expectation for the year. And I say expectation, our pre-war expectation, which was a game changer really for the restaurant industry. Gross profit was enormously impacted by cost inflation, but we managed to do a good job of containing that to be a 2.8% GP loss in gross profit margin. So still a significant impact for the business, but we worked tirelessly with our operations team and our procurement guys to really keep our costs as low as possible without reducing our portion sizes or taking on a lower quality product, because we wanted to make sure that we absolutely kept that good for our customer. We obviously priced a bit last year, and we'll come on to value for money in a later slide. The other thing which impacted us was a 1.1 million loss in EBITDA from utility costs and packaging. Packaging was another area that went up, and utility costs as well. We were unhedged going into last year, and actually because the market was so crazy, we physically couldn't hedge last year. Only recently the forward rates have started to come back to normal levels. So yeah, some really quite exceptional situation last year, and I guess looking at where we are as a business, it is a growth story. Yes, we did generate the EBITDA last year that we kind of hoped we could, but we think that there's things changing now and more optimistic future for 2023 and beyond. So just moving on to then the balance sheet. Not much to talk. Balance sheets aren't the most interesting discussion point anyway, but I guess the main things that changed was an introduction of a 2.6 million goodwill number from our acquisition of Chilango, which had very little net assets on acquisition. And then I've done a reconciliation of the cash going into the year and coming out of the year, which is on this slide, and obviously everyone can have a look through. We obviously used a lot of cash last year for the growth that we've talked about. But importantly, we want to make sure we don't grow a big debt position, obviously with the capital markets as they are and with debt markets as they are, with higher interest rates. So I guess the key challenge for us, the key benefit of this industry is the great working capital benefit you get from opening new sites and growing your business. So we're quite, we've always had this philosophy of trying to self-fund our rollout, which is obviously our aim this year as well. So other than that, there's not too much more. The debt position did change at the beginning or end of the year, still 3 million, and cash we've sort of covered off. So nothing else to cover off on the balance sheet.
And one of the big benefits that we talked about in our last presentation was how the profitability of Tortilla was very much split between London, the South East, and the rest of the UK, commonly known as the North. And actually, that's still a very strong story for us, because we're delighted to have a business that's almost 50-50. In fact, all of our site openings last year were outside of London. So we're very pleased and excited, and we know that our business works incredibly well in Edinburgh, Glasgow, Nottingham, Newcastle, Liverpool, Leeds, Birmingham. So that's great for us to continue. However, I think it's really important that we share this slide around central London. There was a lot of people who were very anti, I wouldn't say very anti, but nervous around the Chilango purchase. It was a business that was very much central London based at a time when there was a lot of talk around working from home, and we were always of the opinion that London is such a fantastic city to work in and to socialise in, that working from home world would definitely have an impact, but perhaps not to quite the extent that it was being talked about. And I think we're starting to see, and certainly over the last, I would say, 4 or 5 months, we're starting to see, outside of the dreaded train strikes, that central London is almost back to where it was pre-COVID. Mondays and Fridays are undoubtedly a little bit quieter. They're not as quiet as they were at the start of this process. And Tuesday, Wednesday, Thursdays are extremely busy. If you walk past any Tortillas or any of the Chilango sites at any lunchtime, any given lunchtime during the week, you will see massive queues, which is really, really exciting and really pleasing for us, because we were absolutely convinced that the Chilango purchase was the right thing to do for many different reasons, but predominantly we loved the property portfolio that they had in central London, and converting those sites into Tortillas has been very successful for us. And I'll get onto the Chilango slide later on. And I also think we're very excited about the next few months. I talked a little bit about Greenwich and how busy Greenwich was going to be over the next few months, but London, I think, will be generally very, very busy. Admittedly, there'll be a lot of UK people who will be going on holiday, but I would imagine that the tourist market in London this year will be absolutely huge. So we're ready for it, and we're very excited to continue to maintain the success that we've seen in London over the last few months. So moving on to Chilango, well, as we've talked about, we bought this in May last year. It's a business that we admired. We thought it was probably the best of the rest. A little bit more independent than us. You could argue maybe slightly cooler, maybe a different type of market, more of a student-y type vibe. We thought the food was great. It was a little bit more premium than us, a little bit more expensive. We'd spent some money in the 3 sites that we've kept as Chilango, and they all look absolutely fantastic. And as you can see from the percentage sales uplift from the first few weeks of us actually buying this business to where we're at now, this only substantiates what I was saying around London absolutely booming. Clearly, we have one outlier here, which is Islington, but we did have to close that site for a few weeks while we refurbed it. And we're still kind of working out the best new management team to bring into that business. But overall, the numbers are incredibly encouraging in terms of the percentages and the increases. And, we love the brand. Now, in terms of what we do with Chilango, at this particular moment, we have put their menu into our cloud kitchens, in three cloud kitchens alongside Tortilla, offering their menu and the tortilla menu. And early signs are very positive. We've only been doing it for about a month or 6 weeks, but we're doing some very good numbers out of these cloud kitchens now, which makes them very profitable for us. So that's good to know that we can run it alongside tortilla on a delivery basis. But it gives us some optionality. It's another brand. We could look at different ways of operating Chilango, or we can carry on trading it as it is. There's no urgency in changing anything. They're good businesses. But it does give us the opportunity of doing some menu testing in Chilangos, and it's nice for us to have another brand. We can look at deciding how best we move forward with it over the coming months and years. As we talked about, we are in the very invidious position of having businesses that are maxed out at lunch times. They're so busy that we need to find ways of getting people through our lines quicker. And through the recruitment of Andrew, he's really been targeted in the first few weeks of his time with us to look at varying options around kiosks, delivery tech aggregation, and other ways in which he believes he can help us with our throughput challenge. As I say, it's a nice challenge to have. When you only operate a single line, there's only so many people you can serve at such a time. So we're looking at kiosks and potentially other ways of operating. And he's going to be a very key player for us in helping us work out the best way of doing that. From a positive tech side of things, you'll notice in the pack that we talk about our loyalty program, we now have just under 300,000 people who are part of the tortilla loyalty program, which is outstanding. It's not a loyalty program where we discount and we give away a load of stuff. We've never been a discount brand. We don't want to be a discount brand. We would rather try as hard as possible to keep our pricing as competitive as we can do. And then we like to add value for people who join us loyalty as opposed to just generally giving stuff away. So it's great that we've got so many people there who are part of our loyalty program. Operationally, going back to the lunch times, we have brought in a Fast 15 program, which is specifically for the London locations where we have huge queues between 12 o'clock and 2 o'clock. And there's incentives for the employees and the management teams to see who can do the most amount of revenue in an hour. And we've already seen 3 records broken in the last few weeks in our London Bridge site. And it's really there to make sure that we have enough people in the businesses when we really need them to be. And you'll see that we are launching a trial around a labour deployment tool to make sure exactly that we absolutely have the right people at the right time in the right place in these businesses. So that's another area that we're focusing on. And as an example of trying to find a way of better dealing with our delivery and in-house sales, Brighton is an interesting example of a site that's now doing almost 50-50 delivery and in-house. And it's a sort of circa 30 grand a week site. So you can imagine with a single line doing 50% of that on delivery, the challenges for the people, for the team on the line to serve people in front of them and with the delivery tickets around them. So we've managed to open a second line in Brighton, a separate second line, which literally facilitates delivery and click and collect. And again, we've only been doing this for the last probably 6 weeks. But the feedback from the employees has been, oh my God, thank you so much. It's made our lives so much easier. We can focus more on the customers stood in front of us now. And the second line can just take all the heat away from all the delivery that goes on. If there are other opportunities in other businesses, then that's another thing we will look at trying to do as we move forward.
Okay, so just onto a couple of slides on value for money, which is something we always talk about and is I guess a really core part of what Tortilla is about. It's more important than ever at the moment with the challenges people have around the cost of living and inflation, and so we want to always make sure that we're really strong in this regard. I think the first graph on the left of the chart shows some customer research we did some time ago, which confirms the fact that the value for money side of what we do is a really key part of why they come to Tortilla. It's really important to our customers. The middle bar chart shows that we are very competitively priced. I've put on here both the now pricing and the April pricing when we put through our price increase. So we'll be pricing by 25p nationwide on a large and regular burrito. Inside London, we'll be pricing by 50p because the work and trialing that we've done and the assessment of the market shows that there is more of an opportunity there to put in higher prices. The cost base is very different, so it feels only right to have a regional type of pricing. But even with that two brand landings, we're in a very strong position from a pricing point of view compared to our direct competitors, and our product is bigger. So with the calorie legislation, you can use that as a proxy for portion size. You can see that our portion sizes for our different products is very strong. Moving on to more of the indirect competition, the wider peer group as well. You'll see really, other than QSR operators like Taco Bell and the other fast food businesses, and the sandwich businesses like Pret and those sorts of organisations, we're really unrivaled at the price point that we're at. And really, I think a burrito is a lot more filling than a sandwich and some of these other products. So we're in a really sweet spot from a proposition point of view where it's putting us in a very, very favourable market position. And interestingly, there was a piece of work done by property consultancy, CACI, recently, which shows that customers have moved to Tortilla from other brands in recent months. On that, I guess, demonstrates the point that we're raising here, which is we haven't played around with our portions like some of our competition have. We've kept our quality, we've not changed any of the ingredients, and we've tried to keep the price as keen as possible.
Yeah, I mean, it's an interesting debate, this one. I mean, Andy and I and the board have always been very, very keen to make sure we are competitive price-wise. We are also cognizant that we are a company that needs to make profitability as much as we can. But I think our view has always been that we are a growth story. We're a business that, there's a long-term plan for this business. And at the end of these constant headwinds that we do believe will end at some stage, we want to be left with a brand that is still considered to be very, very good value for money. And whilst we haven't taken price as aggressively as perhaps some of our competitors, I think it's important to see that quite a few of them have fallen by the wayside over the years. It is very key for us that if we can just ride out the storm for a period of time, we feel we'll be in a very strong position as we come out the other side.
So just moving on then to a short piece on current trading on slide 22.
Oh, yeah, sorry.
We've started the year very well. Our like-for-like sales growth versus 2022, hooray for not comparing to 2019, is 4%. And it's really important to mention that that's against a very strong set of comparatives. We traded really well in January and February last year, pre-Ukraine war, because obviously we were still in kind of Omicron type pandemic situation, and we were doing really well last year. So we're really chuffed to have started the year well. Put a couple of benchmarks down there. January was very high for the industry because a lot of businesses were shut in January last year because of Omicron. It's obviously coming out of that and lapping those numbers, they performed well. But you can see February is more of a normalisation. And the restaurant group recently released their numbers, and you saw the Wagamama was plus 2%. So we're feeling very chuffed that we're holding our ground very well against those businesses. And if you take the VAT out, it's plus 11. So great start to the year. From a cost perspective, obviously it's still a challenging environment, but finally utilities hedges got to a sensible level when we were able to lock in a forward rate on that, which was just not commercially viable beforehand. So that protects us until the end of September. And then we've made a switch to our packaging supply that has saved us about 300 grand a year, which is 0.2% of sales. And food cost inflation feels like it's easing. It's still a challenge. It's probably the one area that we're battling mostly on a daily basis, particularly protein costs. I think veg supply feels a little bit more stable. The meat market is still challenging, but we've navigated our way through it well so far this year, and we're feeling more optimistic about the rest of the year in that regard. And actually, the pricing that we talked about on the previous slide should be enough to give us a bit of headroom to navigate through any further challenges. And as well with the cost of inflation, with cost inflation on employees, 9.7% national minimum wage increase in early April is obviously factored into our forecasting as well. So we're feeling like from a cost point of view, it's more manageable, slightly more certainty appearing in the market, and feeling better placed and well placed for the rest of the year. So just in summary.
Yes. Okay, so really final slide in summary. To have some normalised trading, that would be our wish. But despite everything that's gone on, you know, we had a fantastic full year 22, record site for us. What's encouraging is the 2 sites that we've already opened this year are outperforming expectations, and we've got a very strong pipeline of sites for the rest of this year. We certainly hope to have 5 of them open by the end of June this year. So we're on track to open, as we said we would, which is great news. And so Tortilla continues to be a very exciting growth business. And the white space opportunity for us in the UK continues to be very strong. We anticipate at least sort of between 150 and 175 sites in the UK, so we've got plenty of growth and plenty of opportunity to do that. Andy and I really are very, very close to all of our supply chain. We don't delegate that role to anybody in the organisation. We absolutely know that that's singularly the area that will help us get back to profitability as quickly as possible. We have a very good relationship with all our supply chain, and we're very close to all the costs, and we're looking at many different ways of trying to mitigate all this fluctuation around costs. So we're very close to making sure that whatever benefits there are, we're going to be the first to get them. Probably a bigger push this year in our presentation than there's been in the past is around franchising. We've got a business now that is incredibly well set for franchising success, both in the UK and around continental Europe. We have a strong business over in the Middle East, which has performed very well over the last few months, and some really good opportunities for them going forward. It was very encouraging to go over there and see the success of those businesses. SSP and Compass, whilst being very big, enormous businesses, sometimes a little frustrating at the speed in which they act on things. But fundamentally, in all the sites that we operate with these guys, we're performing very well, and they love the brand. And there will be more opportunities this year for us to continue with that relationship with both of those partners. So franchising remains, and in fact has been pushed slightly more forward in terms of our mind as a really good opportunity and a way of us growing the brand quickly. Our bricks and mortar sites in the UK will always continue to be a very, very, very important part of the business. But it's nice to know that there are other opportunities that we have outside of that. I think it's also important to just reiterate the strengthening of the board and the exec team. One of the successes of any restaurant business, having worked in a few myself, is the level of and the quality of the team of people that are strategically directing it and those that are operating it. And I would say unquestionably this is the strongest board and certainly the strongest exec team that I have around me now. We've got some fantastic skills, some great experience. And I think that will stand us in really good stead going forward to take advantage of all the opportunities that lie ahead. Thank you very much. I think we move into Q&A.
Richard, Andy, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while Richard and Andy take a few moments to review those questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions pre-submitted and throughout today's presentation. And Richard and Andy, if I could just ask you to read out those questions and give responses where it's appropriate to do so, I'll pick up from you both at the end.
Okay, so the first one addressed to me about hedging and reluctance around doing it, and whether or not, given the environment is less volatile, is this reversion more around a return to normal, or we look to potentially unhedge post 2024? Should it be deemed suitable? I think there's a little bit more to the question just underneath.
No.
Was that the next one?
What's the next one?
Yeah, I mean, I've never been against hedging. I think the issue that we had last year in terms of utilities is we couldn't hedge at a commercially viable rate. I think the market was so crazy that it wasn't possible to lock in a rate lock in a forward contract with a rate that was remotely sensible. So only with the rates becoming more normal the last few months have we been able to lock something that in, and we wanted to do that to create a bit more stability and reassurance for the market around our numbers. And we are working with our energy broker to come up with a strategy beyond September, which may be to be unhedged, or more likely we will start forward buying utilities 6 months ahead like now, to cover ourselves for that period. So that's still very much work in progress, but we're neither wedded to the idea of hedging or not.
One from Alessandro. Hey gang, what is the update on the Middle Eastern franchises? Notice they have been declining and we've yet to hear an explanation as to why. Well, as I've just been waxing lyrical about the Middle East franchise, should probably explain that whilst it's true, pre-COVID things were fairly okay over there, and they weren't particularly knocking the lights out, but they were performing okay. Ethos is our franchise partner over there, and they have multi-brands. What we decided to do to help kind of reboot the Tortilla brand within their portfolio was to send over one of my operations guys who has been involved with me in Tortilla for the last 5 or 6 years. A guy called Eric Sadat, who's a fantastic operator, and he went out there to work for Ethos specifically with Tortilla. And in that 12 months he's been out there, he has literally, because he's been a flag waver for Tortilla and has given it very specific focus as opposed to it being part of a bigger organisation. Unsurprisingly, the businesses and the operations have performed much better. They're all profitable, all the sites, and there's a lot of love around Tortilla now within the Ethos franchise business. It's highlighted to them that you have to have somebody owning the brand. So we were out there, and Emma Woods, our chair, was also out there with me last week, really saying to them, listen guys, you know, you've got a massive opportunity here. We're here to support you, but you do need to start pushing forward. It's very noticeable that things are very buoyant over there at the moment. I know the Middle East and Dubai especially is very volatile in terms of ups and downs, but right now they're in a very, very good place and probably will be for some time. So I think it was a great move of ours to go out there. I think we've got them back on the site acquisition program, and I'm very hopeful that they'll open a couple of sites this year. So I would imagine that our Middle Eastern story will be getting better every time we speak.
Okay, so the next question was around, have you been able to increase the prices at the same rate as your costs have increased? I guess the answer to that in respect of 2022 was no. So our EBITDA percentage of sales was lower last year than we would have liked it to have been. But we took the longer term view that we didn't want to have a knee-jerk reaction to price increases by hiking our prices up. I mean, some of our protein costs at times were 40% up what they were at the start of the year, and clearly it wasn't viable for us to offset that in pricing. As we've said, this is a growth story, and we want to make sure that we're building a strong growth story for the long term, making sure that we're careful around our price increases, and doing that in a tactical way that doesn't put our customer off our product. And I think that's exactly the approach that we've succeeded in taking.
Hi, are there any strategic acquisitions on the horizon? Well, we couldn't tell you if there were or if there weren't, so unfortunately we can't answer that one. Are we on target with our expansion plans? Yes, I think so. We are very much on target with everything that we've said, so that's all in good shape. Chipotle has accelerated its expansion program in London. Do you see that as a threat going forward? How would you maintain your dominant position in the UK? Well, we've been hearing for years that Chipotle has accelerated its expansion program, and it actually never has. They've opened 1 or 2 sites. I don't know how many sites Chipotle have now in the UK, but it's only in London, and they probably have, I don't know, maybe 8 or 9 sites, because they've closed 2 or 3. This question is often asked of us about Chipotle. You know, the monster that is Chipotle, nearly 3,000 sites in the US. For some reason, they just haven't performed well in the UK. We have our own opinions on that. We think they're probably a bit too expensive. We feel that their environments are a little bit sanitized and a little bit cold. The model works very well in the States, but I'm not sure it's translated as well over here. They also generally take very expensive sites, very expensive rents. Is that a long way to continue? Well, I don't mind. I think there's definitely plenty of room for another business like ours. But as long as Chipotle don't open as many as us, then we will continue to be the market leader and the dominant position. We're some way ahead of any other Mexican fast casual business in the UK.
Okay, so the next question is from Ben, which is, can you talk us through your franchising ideas in Europe and which countries you are keen to explore initially? Well, Europe is something that's been on our agenda for a number of years. We think there is a clear opportunity for a great burrito business across Europe, and the addition to our board of somebody like Francesca, who's got tons of experience of operating in Europe and of contacts in the franchising world, is obviously hugely exciting for us and opens lots of doors. I guess without going into the specifics of countries where we've identified opportunities, it's not rocket science to identify that the most obvious initial opportunity would be in West Europe, like France, Germany, Spain, Netherlands, those sorts of countries. So that would be the obvious initial target. There are burrito businesses that trade in those countries. We believe that our product is stronger, and so we believe there is a real opportunity to take on some European countries in the near future. But obviously we haven't got anything to announce at this stage, but it's a definite objective of ours.
Do you want to take this one, Andy, or not? Okay, it looks quite a complicated one.
Regarding Tortilla's interim results, I'm struggling to reconcile admin expenses in the consolidated P&L to the notes in the information. The difference is 6.9. Well, the 6.9 million. I mean, off the top of my head, with loads of bits of paper, I don't know the exact answer to that. I can come back on that, but within the financial statements, you never disclose everything that goes into admin expenses. The note just says admin expenses is stated after certain costs, so you can't obviously just add them up and get back to admin expenses. But the main thing in admin expenses are staff costs, rent expense, depreciation, and things like business rates and all those other bits and bobs. So there's a disclosure of certain lines in there, but that's not supposed to cast to the front of the P&L.
Can you add some colour on cost of sales? Well, I think we've been through that, really. I mean, the real cost challenges to us last year and continue this year is obviously protein costs were the big challenge for us, and remains so, although it's not as volatile as it was. And hopefully we've seen a bit of a plateauing of costs in that area. Certainly that's the kind of conversations we've been having with our supply chain on that. Utilities is less of a challenge for us, and as Andy's already said, we've hedged now for the next 6 months, so we're in really good shape on utilities. And labour costs, we budgeted the increase in the minimum wage from the 1st of April. So, you know, whilst it's quite a big hit, we have made allowances for that in our budgeting.
So the next one's from Tim. How quickly do you expect to pay back the Chilango acquisition? Is the performance in line with your expectations? Great question. We paid just 2.75 million for that business. And the foundation of that was an assumption that central London sales would be 20% down on pre-COVID levels, so 2019. So when we looked at the Chilango numbers, we took the 2019 sales of that business, dropped it by 20%, and then played around with the costs. As you saw from the presentation, for our own business sites that we have, that we traded in 2019, the sales are actually 15% higher in Q1 this year than they were in 2019. So there is a considerable sales upside to be had in that Chilango business. The rents were all re-geared during the COVID by the previous owner, so they're very, very good rent deals. So we're really optimistic about the amount of money that can be made within that business. How quickly you can pay it back, obviously that takes a bit of time because you've got to regrow those businesses. We had to work with them. You know, a lot of the people who were in that business left as part of us taking it over. But I think we'll find that we'll make a very good EBITDA contribution from the Chilango sites this year. So you won't be taking many years to pay back that Chilango acquisition at all.
I think we're out of time, unfortunately, now. So I don't know how we want to carry on with these, if they want to get sent over and we can answer them afterwards.
Yes,
Yeah.
Richard, Andy, what we'll do for the questions that remain is we'll send them over to you, and then you can write written responses to those, and then we'll publish those on the Investor Meet Company platform along with those that you've answered during the session. Perhaps before redirecting investors to provide you with their feedback, which is particularly important to the company, Richard, could I just ask you for a few closing comments?
Yes, I mean, listen, thank you very much for joining us. I hope you found it interesting. You know, obviously, this has been another sort of quite a challenging period of time in terms of all the various headwinds that seem to consistently be hitting this sector. But I think it's a very, very good news story. We do continue to perform well. We have a business that we're very proud of. We've got so much opportunity to continue to grow this business. And even during these difficult times, our numbers are very strong. Yes, of course, we'd like to see some cost benefit around our food costs. We're working tirelessly to manage that. The rest of the business is in very good shape. We are benefiting from the continued property market decreasing rents. That gives us a great opportunity to continue to find sites such as Greenwich and Derby, as we've talked about today. We're on track to open the amount of sites that we want, whilst focusing on some really good opportunities around franchising here and abroad. So stick with us. This is a great business, and we're very excited about the coming months and years. Thank you very much for your time.
Thank you, everyone.
Richard, Andy, thanks once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Tortilla Mexican Grill PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.